Video we will talk about the difference between insurance and mutual funds. So if you are also thinking to invest some money and looking for a good option, this video is absolutely suitable for you, because in this video we will understand the difference between the two and where you should invest your money. So basically, insurance is a legal contract, whereas mutual fund is no legal contract. There is no such thing as contract in mutual funds. Insurance is a product where you get insured for your life, whereas mutual fund is a product where company pools in investors' money and invests this money in stocks, bonds, or mixture of both. So invariably, mutual fund is investing in your money in stocks or some other securities and generate some return for you. So as we said, insurance is a legal contract. That's the contract between you and the company, wherein the company promises to pay a life cover, or called as sum assured, in case of any mishappening with the life assured. Now suppose Mr. Harkishan Lal buys this policy, and wherein the company says the sum assured is 5 lakh. So in case of Mr. Harkishan death, the company will pay 5 lakh plus bonus to his family. Whereas in mutual funds, if something like this happens, the person's family will get the fund value. So whatever fund value will be there as per the market scenario, so the family will get the fund value. It can be higher than the deposited amount, or it could be lower than the deposited amount. So as we said, this insurance is a legal contract, whereas in mutual fund there is no guarantee of getting your money back. Or otherwise we can say, suppose you have deposited 1 lakh rupees, so you might get 1,50,000 in your hand, or you might also get 65, 80,000, 90,000 in your hand. The amount of money depends on when you withdraw your money and how much time you give your money to grow. So if you withdraw your amount early, so depending on the market condition, you might get lower value also. But if you hold for a good amount of time, maybe 5 year plus time, so you'll get good amount of money. But that again depend on the market conditions. So in mutual funds, the returns are market based. So that return is varies from time to time, from day to day. If we talk about the safety of the product, basically insurance, if we talk about the endowment insurance plans, so you get the safe returns, whereas in mutual funds usually the returns are market linked and market based returns you get. So even though you invest in the debt mutual funds, the returns are variable. They are not absolutely fixed at fixed deposit. Talk about the safety of the product. So all the insurance policies are usually safe except unit link insurance plan, which again invests in the market linked product. But other products such as money back plans, such as endowment plans, these plans are comparatively safer and give a safe return to you. Whereas in mutual funds, you get market based returns. Now it's one major important factor is the liquidity. Liquidity is the ease of withdrawal your money. So insurance is highly illiquid in nature. That also means that if you have deposited or buy a insurance policy, so if you want to withdraw some partial money or the entire amount, so you cannot withdraw your entire amount, or if you withdraw or surrender your policy, you get a substantially low value. And if you want to withdraw for a while, so you cannot withdraw. Either you can take a loan that is for the reduced value, and for that you have to pay some interest over the taken amount. Whereas mutual funds are highly liquid, you can withdraw your money anytime except close-ended funds. All funds are open. You can withdraw your money anytime. So what you will get at the maturity? In the typical endowment plans, you get maturity sum assured or the sum assured promised by the company plus bonus from the company. So you can expect around 2 times of your money deposited after a span of 20-21 years from your policy. Whereas in mutual funds, you get the fund value. The rate of return invariably is around 10 to 12% if we talk about the equity mutual funds, and it can be higher in case of risky equity mutual funds. The another important factor is tax benefit. In all the insurance products, you get tax deduction under section 80C of 1.5 lakh, whereas in all mutual funds you do not get tax benefit, but you get tax benefit only in case of ELSS mutual funds, which are equity linked saving schemes, and they have the lock-in period of 3 years only. So if you deposit your money in the ELSS mutual funds, then you get tax deduction under section 80C for 1.5 lakh. What is the maturity amount of both the products? So maturity is usually tax-free in insurance plans, whereas in mutual funds, maturity benefit is taxable in nature. So if it is a equity mutual funds and you have withdrawn after a span of 1 year, then the gain up to 1 lakh rupees is non-taxable, and the gain over and above 1 lakh rupees will be taxable at the rate of 10%. Whereas in case of debt mutual funds, the gains before completion of 3 years are added to your income and are taxable as per your tax slab. Whereas in long term, that means after completion of 3 year, indexation benefit is given and thereafter the amount is taxable, but the tax is very low in such a case. So what kind of returns you will get from insurance? In insurance, you get low returns. That is around 5 to 6% you can expect from an insurance policy, whereas from mutual funds you get moderate to high return depending on the what kind of the mutual funds you have bought and for how long you have hold the mutual fund units. Now let's talk about the different type of the insurance plans. Insurance plans are varied kind of the insurance plans. One is endowment plans, which are typical LIC plans of 11, 15, 20, 21 years, 30 years plans. Moreover, money back plans, which in which you get money back during the entire duration, like after 5 years, after 10 years, after 15 years or 20 years, you'll get some money back from your policy. Are pension plans from which you get the pension. There are some other kind of the products also, just like unit insurance plans, that is ULIP plans are also available, whereas in mutual funds it is broadly categorized into equity, debt and balanced mutual funds. So equity means your money is getting deposited in the stocks, whereas in debt means that your money is getting deposited in government securities, bonds, debentures and such type of the products. And the balanced products are the products which invest in equity as well as debt in one single product. So if we talk about the payment options, you can buy an insurance policy with single premium. You can pay for the limited time. You can pay the regular premium. Regular premium means for the entire duration of the policy duration, as well as you can opt for monthly payments, quarterly, half yearly or yearly payments, and the same is case with mutual funds also. So you can choose your own terms with mutual funds, like you can deposit one time, you can deposit regularly, you can deposit on some intervals, you can start SIPs, that is a systematic investment plan there, and you can choose any payment option you like to. that's all for today. So in this video we will learn about insurance and mutual funds. So insurance is basically a legal contract between you and the company, wherein you deposit your money, you get the tax benefit, you get tax free maturity, as well as you get some investment from your money, but the returns are low. Safe returns are there, whereas in case of mutual funds you get market linked returns. Mutual fund, there is no guarantee, but definitely they offer you better returns, and you can say inflation adjusted return from mutual funds. So that's all for today. Let's meet in another video. Thank you for watching. Happy investing.